Hello and welcome. You're watching ET Now and this is all about your company. Today we're going to be discussing Tega Industries. It's uniquely placed. There's a new acquisition as well. And there's going to be large amounts of changes in terms of the fundraising, the way the balance sheet currently looks versus what it will look maybe a couple of years from now. So you want to try and get a good lens into all of that. Let's start off with regard to what exactly the company does. It was incorporated in 1976. Or rather, what I want to know first off, apologies, FY26, the organic or the standalone growth was expected to be 50%. This means that Tega will have to do 1,000 crore in terms of top line in H2. Can it actually do it or not? And that's looking slightly difficult, but H2 is always stronger than H1 and therefore they may well do it. So we try and get guidance on that. Second, the combined entity, which is Molycop plus Tega. Molycop is an acquisition that they've made. It's a far larger company than Tega itself. Just to give you perspective, Molycop is a 15,000 crore rupee acquisition that Tega has made. It's a $1.5 billion acquisition. So around 13.5 to 14,500 crore in terms of acquisition. How quickly can those margins at Molycop recover? And what can the growth clip be for the combined entity of Molycop plus Tega over the next 2 to 3 years? We'll venture into that. Then we'll take an outlook with regard to how debt is shaping up. Molycop has a debt of around 10,000 crore, which is going to get repaid partially over the next year. So around 25% of that debt is going to get repaid. So funding costs will likely come down. Plus, Tega is going to take some amount of debt on its balance sheet to fund this acquisition that they are making of Molycop. So it'll be interesting to see how the debt is really shaping up at a Tega level as well as at a Molycop level. Last off is with regard to return expectations. They've guided for 18% ROEs. Whether they can actually match that and how quickly can they match that is really the question which I'll be asking. And really one more point, very, very linked, this business is very, very linked to the commodity cycle. The commodity cycle currently is playing favorably in the favor of the business. If that were to turn with so much debt and with the kind of business that Tega does, the cyclicality of it, there could be a risk there. So we'll try and venture into all of that in terms of forward-looking numbers and try and get a lens into how that's shaping up. Now let's talk about Tega. It was incorporated in 1976. It's a global leader in mining consumables. I'll elaborate a wee bit with regard to the kind of product it does. But I can only describe it. I mean, in terms of the products itself, I will name some of them, but they're slightly more complex by their very nature. In terms of, it serves around 700 plus customers currently, headquartered in Calcutta and has 10 manufacturing plants. The focus is on wear-resistant products for the mining industry. That's what it largely focuses on. Let's talk about the product lines now. In terms of the product lines, one is consumables, which is 87% of the revenue. And then there's equipment, which is roughly 13% of the revenue. And within that basket as well, consumables is like the everyday items in mining that get used up and worn out quickly. Mining equipment has linings and other consumables that they use, which need to get serviced and installed on a regular basis. That's what Tega does. So it's very, very linked to the mining industry, very, very linked to the commodity space. In terms of the equipment, they also do turnkey projects and they build equipment for some of their customers. They have 700 plus customers in 92 countries. They serve customers like the ones on your screen. Now, NMDC will be a familiar name, but Vedanta is the other one, which they also deal with. And most of their marquee customers, they don't take names off because of elevated competition and the kind of relationships they have with those customers. So not able to give you an exact lens, but you will see them across the mining industry having presence. In terms of consumables, mill liners is one thing that they do. They also do hydrocyclones, which again serves the mining industry. Screens, trommels, conveyor products. If you're familiar with it, you will likely know what these products do. But basically, it's equipment and the product within equipment or the parts of the equipment which get worn out. They try and replace those parts, and hence they are called consumables, right? Now, in terms of geographies, now it's the tilt with regard to geographies is 79% exports and 21% domestic. So, frankly, very low exposure to India compared to global. In terms of the presence, they have 13 sales offices worldwide. The 10 manufacturing plants they have, 7 are in India and 3 are abroad. And now with Molycop, some of these may well change in a big manner. So let's talk about Molycop. It's a leading global supplier in grinding media for the mining industry. It provides Tega a very, very broad base in terms of the products that Molycop offers, and therefore across the value chain now Tega has presence with this acquisition. It's a far larger company than Tega itself. 13,000 crore is the enterprise value. The valuation multiple is at around 8.6 times FY25 EBITDA, and the transaction closing is expected to happen on the 31st of December. The transaction, by the way, materialized just about a couple of months ago, so it's not a very old transaction either. The funding mix is going to be equity, which is QIP and preferential allotment, including promoters also subscribing to around 150 crore of equity, and then there is going to be debt. So broadly, that's the split. We'll talk about what happens to promoter ownership as we go by with regard to the metrics, and let's dive right in with regard to the metrics. Now, mind you, these metrics are for Tega standalone at this point. I've not added Molycop, obviously, because these are backward-looking numbers, but you want to keep that in perspective when we have discussions with the management, because when you are looking at the numbers will change materially if I were to add Molycop. Let me give you an example. At 1640 crore in terms of top line FY25, with Molycop, this top line will go above the 50,000 crore number. So you just want to keep that into perspective. It's nearly 10 times in terms of the size, or 9 times in terms of the revenue size. So you want to keep that in perspective. But Tega has done ever so well. It's done a 20% 3-year revenue CAGR. In terms of EBITDA as well, 23%. They clocked very healthy EBITDA margins, around 20-21% EBITDA margins in this industry. And they also have grown profit at 20%. So it's a fairly healthy set of numbers, at least on the growth front. Now let's look at margins and let's look at some operating metrics. In terms of the margins, the margin trajectory has largely been steady. H1 generally is more muted, and that's why you're seeing those last 2 bars where the margins have compressed. But the rebound in H2 is what you will see, and likely you will continue to clock those margins, those 20 to 22% margins on a standalone Tega level. So that's how the H1 numbers look like. 761 crore. Now 1650 crore was the line for FY25, and a 15% growth is what what the company has guided for. So you want to keep your eye out on that and whether they are able to follow that guidance. Let's look at the balance sheet. The equity plus or the book value of the company is around 1476 crore odd. So that's the equity on the balance sheet, which is likely to inch upwards by at least another 10 to 11 crore. So you want to keep, again, note of that, because of the fresh equity raise that they're going to do, 2,200 odd crore equity raise at around rupees 2,000 apiece. So that will mean around 11 crore rupees of equity added, plus the reserves will also get enhanced. So the entire equity value from 1476 crore, which is the current reserves plus equity, will go up by another 2,200 crore. So that's a large equity raise that they are likely to do. You want to know that. Second is your borrowing. Your borrowing number currently is fairly controlled at around 230 odd crore, but that will change. Going forward, this will go up and go up substantially. And where does the debt number go is something that's interesting. Second, what is the cost of debt is the other piece which I'd want to know. The cash and bank balance is around 120 crore at least at this point. Let's look at cash flow now. Cash flow, the working capital cycle is difficult in a business like this. It takes time, and therefore you'll see the cash flow from operations to EBITDA is fairly lagging. You look at cash flow from operations at around 200 odd crore. The EBITDA is around 340 crore, and that's around a 60%. But that's just the nature of the business, right? And therefore, you want to keep that as well into perspective when you're looking at these numbers. Let's look at return ratios now. They've been very, very healthy, frankly. They've maintained a very healthy ROC all throughout, above 18% ROC across. It's obviously come off, but it's still a very, very healthy number. So therefore, we've given this a thumbs up. well, if you can see on the top of the screen. Let's look at shareholding now. 75% currently owned by promoters. This will dip to 64 to 65% region after the acquisition of Molycop. Also, Molycop is going to be a joint acquisition. 77% by Tega, 23% by Apollo. So as that acquisition kicks in, it's only 77% of the profit that attributes to Tega. But eventually, they will give Apollo an exit, is in all likelihood. So that's on the shareholding part. Currently, 64%, also fairly healthy. So we've given it a thumbs up. The number of shareholders is fairly steady over the last maybe 3 to 4 years. So no concerns there at all. Let's look at valuations now. In terms of the valuations, FY26, it's trading at 48 times. This is basis consensus. I haven't been able to calculate the valuation largely because there are so many variables, including Molycop. But this is basis consensus expectations of the analysts on the street. 48 times FY26, 37 times FY27, and the 5-year average is as you can see 40 times. So fairly neutral there. 3 buy calls, 2 hold calls, and you have a 13% upside, but you don't have too many analysts tracking this, and therefore we've again given this a neutral as well. Don't want to be aggressive there. 13% upside is what they see. Now, what we're going to do is we're going to speak with Mr. Mehul Mohanka, the Managing Director and Group CEO of Tega Industries, on the other side of this very short break. Stay with us. Welcome back. This is all about your company, and we're talking about Tega Industries today. Let's pull up the metrics that we've discussed. Just do a quick refresh, and it'll just come up on your screen in just about a minute. Let's go across. So that's the way our metrics have shaped up with regard to our Tega. Now let's go across. We have Mr. Mehul Mohanka joining us, the Managing Director and Group CEO at Tega Industries. Mr. Mohanka, great having you. Let me first start off by understanding what the outlook for FY26 now looks like, because H2 is typically stronger for you in terms of seasonality, but you have plenty of work to do in H2 to achieve that 15% growth guidance. How comfortable, confident are you of doing that?
Good afternoon. Thank you for having me on the show. As we look at H2, and as you rightly said, I mean, H2 always has been way stronger for us than H1. And as we look at things folding out for us in H2, we are pretty much on track in terms of our 15% growth. As always, we've been guiding the market.
Okay. And combined with Molycop, you're at around 15,100 crore in terms of top line. Now, Molycop will likely merge with you, and the numbers will come on a combined basis by maybe FY26 end. What's the kind of growth outlook for FY27 that one can pencil in on the combined entity, very likely? And how sustainable is that, maybe over the next 2 to 3 years?
Sure. So the estimate is that we should be able to look at consolidated numbers by end of this fiscal year. But as you know, that we are all subject to antitrust regulatory approvals. So it's something not in our control. We are hoping that by March we would be able to consolidate, but that can get stretched out depending on the approvals that we're expecting shortly. So as far as Tega's growth rates are concerned, let's split the business between consumables, equipment, and then Molycop. So if I look at Tega's steady state as where we are today, we have been always guiding 15% growth rate on the consumables business, and I think that's where we will continue to deliver on. The equipment business has been growing for us quite phenomenally. We see that tracking north of 28% growth on the equipment side, which is basically the McNally acquisition. Molycop today, from where we are sitting at, we look at Molycop to be somewhere around 6.5–7% growth in FY27. And that's what we are factoring in terms of how we're going to deliver on the 3 combined businesses put together.
Mr. Mohanka, how linked is this commodity cycle? And you expect the commodity cycle to continue to aid you?
So, as what we would always been saying, the beauty about Tega is that we're in the OPEX spend of the mining cycle. So we're not linked to commodity prices. as long as the mine is operating, they need our products, which are critical to operate consumables. And Molycop, as well as Tega's consumables business, are pure play OpEx spend for the mining companies. So irrespective of wherever the metal prices are, as long as they operate the mine, they need our products.
Correct. But Mr. Mohanka, if the mine were to reduce its scale of operations as a result of demand-supply mismatch, or if the mine were to completely shut down, that would impact your numbers. And therefore, I'm trying to get to the point as to whether you see the commodity cycle turning, because you've got very good visibility of that from where you sit.
So if I can put some perspective into that, almost 80% of our revenues come from gold and copper. These are the two strongest metals for us. And they're pretty much looking very strong where we sit at. I think the next 5 to 10 years, I think gold and copper is looking pretty good. So there are less concerns around how commodity prices will play out on our revenues. Secondly, if one was to understand the mineral processing plant per se, it's not very easy to tone down the productivity or ramp it up. There's certain fixed, I would say, input and output in a process plant. So either you run the plant or you shut the plant. It's very difficult to dial down or dial it up like a furnace, for example.
Okay, I understand where you come from. Now, Mr. Mohanka, if I were to try and get a sense on where margins go for you, at least on Molycop in particular, you've got a couple of segments or businesses within Molycop which are loss-making, which have dragged margins. Traditionally has been 14%, currently at about 11%, combined entity at around 12%. Correct me if these numbers are wrong. How quickly can Molycop on a standalone basis margins go up? And what does the combined entity margins likely look like in FY26? And what's the scope for increase thereafter?
Sure. So, yeah, I mean, let me make a few corrections to your assumptions today. I think, so Molycop is operating at about $1.5 billion revenue with 12.5% EBITDA margins. We're looking that to expand into closer to 15% in 27, and then ramping up to about 18% from year 28, 29 onwards. So that's how we're looking at the business grow from 27 onwards. In Molycop, we have to be a bit cautious because today they follow a different, I would say, financial calendar. So they run July through June. So post close of the transaction, we would look at bringing that closer to the Indian financial years, which is April to March. So without getting into the complexity of restating financials at this point, I would say that on an Indian calendar basis, financial calendar basis, we were looking at delivering those kind of set of numbers, which is about close to 7 to 8% growth over the next, I would say, through FY28, and then expanding EBITDA margins to about 15% from current 12.5%.
Got it. Okay, that's clear, but I'll have to do the math in my head. While I do that, give us a sense of where the debt goes, Mr. Mohanka, because now you're going to saddle Tega with some amount of debt as a result of the acquisition. Also, Molycop sits on maybe 10,000 odd crore of debt, out of which around 2,500 crore of debt is going to be repaid. Give us what the cost of debt is and what happens in terms of the debt trajectory over the next 2-3 years.
Yeah, so Tega's going to have about 1,000 crores of debt on its books, on its balance sheet to fund the transaction. And Molycop's going to have $700 million of debt on its books. I would like to also highlight the fact that Molycop's debt is singularly ring-fenced in terms of it's going to be only on Molycop's balance sheet and is not going to impact Tega's balance sheet. So there's no recourse to Molycop's debt on Tega's balance sheet. And we're looking at leveraging the business down to about 2.5 turns of debt over the next, I would say, close to 3 to 4 years is what the plan is. The cost of the debt is roughly at around, I would say, 7.5%. Is what the term loan in Molycop is going to be sitting at and costing us.
Okay, Mr. Mohanka, it's been a very good conversation. You've given us great clarity with regard to the numbers. 17-18% margins viewers, is not something the analyst community is building in. But Mr. Mohanka, thank you so much for giving us that guidance and kind of bringing it out as to how the journey will look like in terms of the combined entity. Viewers, if this were to play out 7-8% on the top line of 15,100, 15,200 crore, and then on top of that, you have margin accretion coming through from the current 12-13% to maybe 15% very quickly, and thereafter 17-18%, this could well be a big changer. But completely out of time on this edition of AAYC. Thank you so much, viewers, for joining us. It's a goodbye from all of us here.